Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, October 9th, 2024. As always, we'll start with the executive summary from today's lit-up morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, will the Fed minutes disrupt globally coordinated easing? And will recent U.S. dollar strength disrupt globally coordinated easing? Our answers are, we do not anticipate the Fed minutes or subsequent forward guidance to disrupt globally coordinated easing. In fact, recent Fed speak has all been around the pace of rate cuts, not whether further rate cuts are necessary in the first place. Our highest conviction view since early November of last year has been our J wants a soft landing theme, which has called for the Fed to maintain an asymmetrically dovish reaction function, which is consistent with how the Fed has historically approached fourth turnings. Far too many investors have lost money re-upping subscriptions to bear porn newsletters in the context of this dynamic. All around the world, we continue to observe evidence of globally coordinated easing. Moreover, liquidity is currently trending higher in every major economy except for Brazil and the US, supporting the persistent uptrend in global liquidity that our global liquidity monitor signals is likely to accelerate over the medium term. Transitioning to our 42 macro dashboard here, as always, we'll wrap up with a question from our community. This one's regarding war, oil, and risk off. So, hello, Skipper. Following KISS, but just wondering if Middle East war escalation is on your radar. We've never seen it much in research slides. Is there any chance escalation could cause oil to go up, thereby resulting in inflation to bounce and cutting the risk of Goldilocks short? Just curious regarding your thoughts on that. Perhaps it is so unpredictable of a variable that you don't put much time on it. Regards. This is a good question, and it's a good question that allows us to embellish our process and how we think investors should be approaching sort of dynamics like geopolitical tensions, wars, etc. From our perspective, the things that matter most with respect to perpetuating dispersion within and across asset markets are the following sort of 5 to 6 cycles, and one of them is kind of just an accelerant. If you think about the growth cycle, that's very important. The inflation cycle is very important. The policy cycle is very important. The liquidity cycle, which is sort of the sum of all those 3 cycles, with the addition of the corporate profit cycle as well. So if you put those sort of 5 cycles together and then layer on the positioning cycle, which acts as an accelerant, whenever you have a significant enough inflection in one of those previous 5 cycles, that's how you get asset markets right. And so as it relates to oil perpetuating a trending risk, the war perpetuating a trending risk off market regime, you have to look at it through the lens of, will this dynamic, whether it be a escalation of Middle East conflict or a Russia-Ukraine invasion, etc., will this conflict, cause one of those material cycles to inflect, not just to inflect, but and persist in a manner that's negative for asset markets. And so in terms of how we think about, the Middle East, escalating tensions in the Middle East, obviously if we had a significant supply reduction in crude oil, which I would argue it's almost impossible to have a significant supply reduction in crude oil. It's not like Iran is pumping a lot of supply onto the global oil markets at the current juncture. But if it were, if you had a significant supply reduction in crude oil, then you would have a sustained rally in crude oil, which would obviously create a positive shock to inflation, which may actually cause the policy cycles, which again, we're talking about globally coordinated easing right now. It may delay further policy rate easing by the world's major central banks, and particularly the Fed, which could ultimately cause the dollar to strengthen and ultimately sort of sap the uptrend in global liquidity vis-a-vis currency volatility and FX volatility as associated with the unwind of those rate cut expectations. So this is something that could cause it, but it's not going to cause it in isolation. The headline that Israel and Iran is moving into accelerated conflict is not the reason markets will go down. You have to kind of connect the dots, follow the bouncing ball back to one of those 5 cycles that really matters to investor positioning. And so investing, that's how we're thinking about this risk. Ultimately, we don't see it as based on the current constellation of our fundamental research views and the current constellation of our, sort of quantitative risk management signaling, we don't see that as the highest probability outcome in terms of Israel-Iran acceleration leading to a trending risk-off market regime. It may cause a correction. Markets don't go anywhere in a straight line. And so anytime you're in a bull market, you should be expecting 2 corrections a year, which is historically what's happened, 2 meaningful corrections a year in a bull market. Or if you're in a bear market, what's historically happened is you've had a couple of significant dead cat bounces or significant kind of counter trend rallies in the context of bear markets per year. That's the historical empirical outcomes. Obviously past does not predict the future in terms of what actually happens in financial markets, but investors need to be aware of all these types of dynamics. So kind of just wrapping up, I do think it's important to understand that If you go back and you look at, historical wars, particularly here in the U.S., you go back to, I want to say in 2001, shortly after 9/11, I want to say in October 2001, we had a pretty, shortly after 9/11, we had a couple weeks where the market was down, I want to say 7 to 10%, and then it recovered within a month. And then in 2003, when the U.S. invaded Iraq, the S&P was down like 5-6% in a matter of a couple of weeks and recovered within a month. So investors need to be aware that these geopolitical dynamics in isolation are not ever going to be the cause of a trending risk-off market regime. What are always the causes of trending risk-off market regimes? And take out your pen and write this down, because this is some real good wisdom here. What causes trending risk-off market regimes is one of three things usually. One, the growth. You have a surprising and protracted deceleration in growth. You have a surprising and protracted acceleration in inflation, or you have a surprising and protracted tightening of monetary and or fiscal policy, usually both, which obviously if any of those three things happens, you're talking about a surprising and protracted decline in global liquidity. So those are the three things that you need to be aware of. And forecasting, if you expect a trending risk off market regime, much like what we saw, obviously, in COVID was kind of short and sweet, but 2022, 2018, Q4 2018, something like, early 2016, 2011, 2010, middle 2010, 2009, 2007, 2009, 2000 to 2003. If you're expecting something like that, then you need to have one of those three or multiple of those three things occurring. And based on our fundamental research views, we don't see those things as likely over the medium term. So we'll wrap it up there. Great question. Hopefully everyone got some wisdom out of that. So we'll catch you back here tomorrow. This is Darius Dale signing off our Macro Minute for Wednesday, October 9th, 2024. Best of luck out there. Catch you back tomorrow. Cheers.